am Dave Cowan, and one of the organizers of Modern Ideas for Business and your moderator for today. I'm the founder and CEO of Silicon Valley Sales Group, a Sandler sales performance company. I consult, coach, and train business owners, professional service providers, and sales leaders with teams of 3 to 10 or more salespeople in a proven sales process that enables them to sell with greater confidence and achieve predictable, profitable growth. Our mission at Modern Ideas for Business today is to enable business leaders to find opportunities and resolve challenges presented by the changes in the economic, political, and legal landscapes in which they compete. We empower business leaders with the knowledge, skills, networks, and actionable insights necessary to achieve sustainable success. To that end, we sponsor monthly webinars like the ones today by experts in their field. We will record today's talk and send you a link to the recording and a copy of the slide presentation within a few days of its conclusion. You can also view recordings of past speakers at modernideasforbusiness.com. The other organizers for modernideasforbusiness.com include Ed Correa, CEO of Sagacent Technologies, a global leader in cybersecurity solutions and digital risk management. Paul Duran, a commercial banker for over 25 years and now an expert loan consultant, serving small and medium-sized businesses looking for the methods and means by which to grow their businesses. And Jaco Grobbelaar, CEO of Broad Vision Marketing, developing and executing inbound marketing strategies that enable clients to consistently create more sales-ready prospects. We started Modern Ideas for Business with the goal of creating an interactive forum where business leaders can learn from experts in a variety of fields, ask questions, and share their thoughts and opinions on the topic of the day. So during today's webinar, feel free to come off of mute and ask questions or offer your thoughts and opinions. We'll also be monitoring chat if you want to ask questions there. With that, I'm happy to introduce our speaker, Jay Jung, Managing Partner at Embarc Advisors, a modern M&A and CFO advisory firm serving startups, as well as middle market Fortune 500, venture capital, and private equity firms. Leveraging his MBA from the Wharton School of Business and subsequent experience as a consultant at both McKinsey and Goldman Sachs, Jay established Embarc Advisors over 7 years ago with the goal of disrupting M&A advisory. Unique in the industry, Embarc bills on an hourly basis and charges no success fee. This model aligns Embarc's incentives better with middle market business owners, allowing Jay and his team to provide top-tier financial expertise with white glove service from the start of the engagement all the way through the close. This has earned Embarc recognition twice on the Inc. 5000 list and a multi-time inclusion on Axial's list of top 20 investment banking firms. So Jay truly is an expert on maximizing value by minimizing capital gains tax as an expert, the topic of our conversation today. So with that, Jay, I'm happy to turn it over to you.
Right. Thank you, David. All right. So I appreciate the opportunity to be here. Thanks for Modern Business Ideas. So as David mentioned, the topic for today is maximizing value and exit. And in particular, we're going to talk about how to minimize taxes through qualified small business stock. David already gave my introduction, so I won't repeat it, but I want to emphasize. As David noted, I've had the pleasure of working on really big deals like selling Yahoo to Verizon. I've sold MuleSoft to Salesforce.com, et cetera. And really, as a recovering entrepreneur from the early 2000s, the idea behind Embarc was to bring some of that toolkit to middle market business owners. So a little bit about how we got started. We started off, given my background, doing M&A advisory, buy side and sell side work. And then we quickly realized that a lot of companies don't actually have exit ready financials. They might be doing accrual accounting. Some of them may even be on GAAP. But that's different from having exit-ready financials. So we built out a quality of earnings team led by a former Big Four consultant. And lastly, even though we were selling companies well, our clients were happy, we noticed that there were still a lot of low-hanging fruit left on the table. And if they had prepared 12, 18, 24 months in advance, they would have picked those off and enhanced value significantly. But unfortunately, those were left for the buyers to pick up. And one of those things that the low-hanging fruit is around taxes. So when we talk about M&A, I think a lot of people talk about EBITDA times a multiple. I go to a conference, I go to an M&A track. There's always talk about the multiple for this kind of business should be about 6 times. As you get bigger, it's 8 times. If you get to 5 million, it's not 9, 10 times, and so forth. And I want to emphasize, as an owner, the value is EBITDA times a multiple minus taxes. And there are things to do to maximize EBITDA, say like a quality of earnings. There's things to do to maximize the multiple, where we'll emphasize financial planning analysis, which is essentially financial storytelling. And today's focus is how do you minimize taxes through qualified small business stock? So when it comes to tax planning, it's all about structuring and advanced planning. And because most of the companies in the middle market are S corps, there's a corporate level of taxes, and then there's a personal level of taxes. I'm going to talk mostly about the corporate level, but it's also worth noting that there are a lot of tax strategies in the personal level where if someone plans in advance, they can get significant tax savings at time of exit. So on the corporate level, when it comes time to do the deal, there's a debate around, do you do an asset deal or a stock deal? And in most cases, a stock deal is more advantageous for the seller. Today, we're going to talk about qualified small business stock, which helps eliminate some of that capital gains taxes. In conjunction with QSBS, I'll mention a little bit about 1045 exchanges. And lastly, I think another big blind spot for business owners is phantom stock. Most business owners give phantom stock to their employees to incentivize them and don't realize that it's probably the worst tool among equity-like incentives. And oftentimes we would recommend profits interest because profits interest gets capital gains treatment, whereas phantom stock is going to be taxed at ordinary income, which in California, if you take the federal and state taxes, that's going to be 40+% at time of exit. So let's dive into qualified small business stock. So here's a real case study. We recently sold a 2 million EBITDA business. It sold for $20 million. So that's 10 times EBITDA. The buyer was a private equity backed strategic. And the two owners, Ted and Harry, each owned 50%. So they got $10 million each. The kicker here is they paid zero in federal capital gains taxes. So how did they do that? They took advantage of qualified small business stock, which is section 1202 of the Internal Revenue Code. And essentially, QSBS is a tax incentive with the goal of driving investments and the founding of small businesses. It's the government saying, hey, you took a lot of risk in starting a small business or investing in a small business. So we're going to reward you. And the reward is when you exit, when you sell that investment, you're going to get a tax benefit that excludes 100%, up to 100% of capital gains on the sale of qualifying small business stock. So then what qualifies as qualifying small business stock? You have to have founded or invested in a small business. And a small business, from the tax authority's perspective, is anything less than 75 million gross asset value. So not that small. It has to be in a qualifying business category. So what's not qualifying? Anything in banking, insurance, metals and mining, restaurants, hotels, those don't qualify. But a lot of businesses that manufacture something, that sell a widget, even certain types of services businesses, boutique practices, et cetera, can qualify. So now, if you are a founder or investor in a qualifying business, you have to have held it for at least 5 years. It has to be original issuance, which means you have to have received stock from the company, not bought it from someone else, not bought it from the founder, not bought it from an ex-employee, but you have to get it from the stock from the company. Lastly, it must be a C Corp. And this is where some people might say, that doesn't apply to me. And don't tune out just yet, because I'm going to talk about how an LLC and S Corp can also convert to a C Corp and actually take advantage of certain tactics within QSBS that allows them to take an even bigger tax deduction. And recently, Congress has recognized that QSBS is a great tool to incentivize Americans to start businesses and invest in them. So in the recent OBBBA, they made QSBS even better. Before July 5th, you had to have held the business for at least 5 years. It's 5 years or nothing. Now they made it a phased approach so that in 3 years, you get 50% exclusion. 4 years, you get 75%. And 5 years, same thing, you get 100% exclusion. Also, they increased the exclusion. So the base exclusion went from 10 million up to 15 million. And lastly, as a footnote here, before a small business was defined as 50 million or less in gross assets. And then, as I just mentioned, now it's 75 million or less in gross assets. So essentially, they made it so that more companies can qualify. They'll get a bigger tax benefit and they'll get it sooner. QSBS was a great tool before. It's just become an even better tool since July 5th. So what does this mean? If your business is worth $15 million today, if you have private equity buyers, strategic buyers knocking on your door saying that they'll buy your company today, at $15 million from a federal capital gains tax perspective, you'd have to pay 3.6 million taxes. That's about 24%. If you convert to a QSBS qualifying company today and you wait 3 years, that goes down to 2.4 million taxes. After 4 years, it's 1.2 million in capital gains taxes. After 5 years, you don't pay any federal capital gains taxes. That is a big difference. If you end up with 11.4 after taxes and cash proceeds versus ending up with 15 million, that's a very big difference in your retirement life. Now, it gets better. QSBS also has provisions that allows the seller to stack those benefits so that they get more than $15 million in benefits, or they can use a high basis QSBS. And this is where business owners that started their company as an LLC or an S Corp are going to get like an unexpected windfall here through a high basis QSBS. So let me talk a little bit about each of these. So QSBS, the 15 million base exclusion, it applies on a per legal entity basis. So basically, each person can get $15 million. You get $15 million as an owner, your business partner could get $15 million, your investor can get $15 million, and so forth. From the IRS lens, certain types of trusts, irrevocable trusts, also qualify as a separate entity. So that means that trust can get a separate $15 million quota in terms of capital gains deduction. And lastly, if you have family members and they own stock, they can also get $15 million in capital gains deduction. And so this is what stacking looks like. The business owner gets $15 million in exemption. The trust gets another $15 million in exemption. Family members get $15 million in exemption. And I was recently talking to a tax lawyer that mentioned that because a certain business owner had so many children, they were able to set up multiple trusts. So they were getting, in that second layer, they were getting multiple $15 million exemptions. So the capital gains exemption can start stacking up, in this case, up to $45 million or more. So again, this is where advanced planning can make a big difference in the tax outcome, even for QSBS qualifying companies, because each of these entities would have to hold the stock for at least 5 years. So now let me talk about the benefit of a high basis QSBS. The actual rule of QSBS is that you get the greater of 15 million or 10x the initial investment. Taxes are usually something about the lesser of. This is one of those few provisions where they're going to lean into the benefit of the taxpayer and give you the greater of. So what does that mean? If you start if you found a tech startup as a C Corp, because you started it from nothing, your basis is zero. So you default to option one. You'll get $15 million in QSBS benefits. Maybe you can stack that up later on as you get close to an exit. But for many of us that have started our business as an LLC or an S Corp, to take advantage of QSBS, we would convert to a C Corp. When you convert to a C Corp, it's treated as if it's a new investment. And most of our businesses, because they are currently operating, generating revenue, generating profits, the value wouldn't be zero. And so in this case, when we convert from our LLC or S Corp to a C Corp, if we say, I think today's value of the company is $3 million, you would take option two, where it says you get 10x that initial value. So in this case, $30 million in capital gains exclusion when you sell the business. So you get to choose between the base 15 million or 10x your basis. And if your conversion basis is 3 million, that's 30 million. If your conversion is 10 million, you can get up to 100 million in capital gains free. So it's a really powerful lever. And it's kind of like an unexpected blessing for all of us that's ended up starting our businesses as LLCs or S Corps. So what does this mean? Let's say your business today is doing 10 million revenue. It's a 15% margin business. You have a 1.5 million EBITDA. Average 1.5 million EBITDA business, whether it's in manufacturing or services, trades at say 8 times. So it's $12 million value today. Now you could convert this business to a qualifying C Corp. And if your goal is to grow the business, let's say 2x it over 5 years, so it's going to be a 20 million revenue business, your margins expand a little bit. So now you're a 3.5 million EBITDA by end of 2031. And let's say conservatively, this business trades at a 10 times multiple. Now the enterprise value is 35 million. So in one universe, you didn't do anything. You just kept running the business as is. In 2031, you're selling your business. It's $35 million. All of it gets taxed. You're going to pay probably around $8 million in federal tax from capital gains. Depending on which state you live in, let's say on average, you'll pay about 2 million in state taxes. So your net after-tax proceeds is only 25 million. If you had converted to QSBS in 2025, and you set a conversion basis of, say, a modest 3 million, you would pay taxes on the first 3 million. But then you get $30 million, 10x that basis, capital gains free. And you had a little bit left over, so you might pay an additional 2 million. And so you end up paying taxes on only 5 million of the 35 million. Huge difference in outcome. And again, it's one of those few levers that you can pull that will have a multi-million dollar impact on the end results. You just have to plan in advance. It's kind of like getting 2 turns more in a multiple when you sell. So you hear all of this. It sounds interesting. I found that the next step is for business owners to go to their CPA and say, hey, I went to this webinar. This guy was talking about QSBS. I want to look into it. The most common response from the CPA is, shucks, you're not eligible because you're an LLC, you're an S Corp. This thing, it only applies to C Corps. And so I want to preemptively let you know that there is most certainly a way to restructure an LLC or an S Corp to a QSBS qualifying C Corp. And it's very easy for LLCs or LLC partnerships. For S Corps, you would have to do an F reorg, which is still very manageable. So the next question would be, okay, fine, you can do that. And then they say, but if you're a C Corp, you get double taxation. It's very bad. You're gonna probably lose more money than you would save when you exit. And once again, I want to preemptively let you know that there is a simple structure that allows the business owner to reduce that double taxation leakage so that you're not actually losing a lot of value in the interim 3 to 5 years until you exit. So this can also be solved. Now, of course, some business owners will say, I can't wait 3 to 5 years. I plan to retire in the next 1 or 2 years. And that's totally fair. And of course, some people are just going to retire and then they're not going to work, not going to start another business. And that's totally fine. But for some of us who are serial entrepreneurs and say, I'm going to sell this business because the market's hot now, and then I'm going to start something else. Maybe it's an AI startup. Maybe it's something else. If that other business is also QSBS qualifying, you can roll that basis and keep the clock going in the second business. So this is also partially solvable. And lastly, when I go to conferences, when I hear people talk, other M&A advisors talk, a lot of times the pushback is private equity does not do stock deals. They only do asset deals. And I'm going to say from experience, that is simply not true. There are plenty of situations where private equity does stock deals and stock deals for QSBS qualifying C Corps. So again, most of the perceived problems on the surface are solvable. But I want to be honest and mention QSBS is a very niche topic. It's not something that every tax expert practices. And in general, the tax preparer who gets paid $1,000, $2,000 a year to file taxes is not a QSBS expert. And I think it's because of the deep expertise and niche nature of this topic, it's important to work with someone that has done a lot of these transactions. So I'm going to talk a little bit about each of these so that you also have a sense for how you can mitigate some of these hurdles, because even though it looks complex, I think it's a huge benefit that's accessible to a lot of business owners. So first of all, if you're an S Corp, what do? Most S Corp owners look like this. They have a structure, and then the owner owns the S Corp. So what do you do in this situation? You do what's called an F reorg, and the resulting structure is what looks like on the right-hand side. And there's a lot of benefits to this, despite the apparent complexity. First of all, you'll notice that there is a new S Corp on top of the C Corp. And that C Corp is your new operating entity. So that C Corp, when a buyer comes in, they are going to buy the stock in that C Corp and therefore make it a QSBS qualifying transaction. So what is that new S Corp for? That new S Corp is where the C Corp is going to pay management fees. So the C Corp reduces double taxation. The C Corp pays management fees to do S Corp. The owner is still the sole owner of that S Corp, and the owner will get paid a W-2 wage to minimize their payroll taxes and Medicare, Medicaid, all that stuff. And then the rest will take in distributions. So from the owner's perspective, not that different from where they are right now, and not a terrible large amount of double taxation happening at the C Corp. So we solved, this kind of solved the first and second problem that I listed above. So what's that LLC downstairs for? Through the F reorg, the F reorg is really a multi-step process. Your original S Corp becomes the LLC at the bottom. And we do that because we want to keep that S Corp's EIN. As I mentioned, to qualify for QSBS, it has to be original issuance. So you have to set up a new C Corp. And if you simply operate it out of that new C Corp, you would lose the old EIN. You would have to use the new C Corp's EIN. And so one of the other benefits of the F reorg is that the S Corp gets to preserve the same EIN at that new LLC level. And same EIN means you don't have to get new bank accounts. You don't have to move all your employees to the new entity, and you don't have to redo your contracts. So you get to avoid a lot of operational disruption. So again, the F reorg is key to converting an S Corp into a QSBS qualifying C Corp. So now I'm going to touch a little bit on the 1045 exchange. So we had a client where they were an S Corp. We were able to convert that into a QSBS eligible C Corp. But as you were learning more about the client and talking to him about why he wants to sell, what he's going to do after he sells, what is his plans, and all of that stuff, we came to realize that his idea was, and he had already started a side business. And for him, retirement was to work on that side business. Well, we talked about what is that side business? And then we did some research and realized that side business can also be a QSBS qualifying company. So now we converted a second company to also be QSBS qualifying. And what that enabled was we sold the first company. It was sold as a stock purchase to a private equity firm. And then we rolled, because it hadn't been 5 years since they converted to a C Corp, we rolled the basis using a Section 1045 rollover. It's kind of like a 1031 exchange in real estate. So you roll the basis into the second company. And so as long as he holds the second company for the remainder of the QSBS period, he will qualify for QSBS. And I find that a lot of business owners are serial entrepreneurs if they have the opportunity. And so, once they exit a business, they're not going to just kick back and relax. They'll start something else. And so the 1045 rollover also doesn't have to be for all of the proceeds. It could be for a portion of the proceeds, but it's another very important tool that allows to, at the very least, even if it's not QSBS qualifying, defer some of the taxable gains. In this case, potentially eliminate some of the gains. So another great tactic that's available at time of exit. And lastly, a lot of people will again say that private equity doesn't.
Jay?
Yep.
Okay, sorry for interrupting. We have a question from Yaku in the chat. It says, if a company gets acquired via a merger, does the surviving entity need to maintain certain activities for the QSBS to remain valid?
Yeah, so good question. First of all, there are multiple requirements for QSBS to remain valid in that situation. So first of all, the acquiring company or the merged entity has to also be QSBS qualifying. The rollover has to be done in a way that maintains the QSBS validity. And then the QSBS benefit will be capped at the value. Oftentimes, the QSBS benefit will be capped at the value of the exit, and there may not be any further exclusions from there. So it is a little bit case by case. I would say yes, it can remain valid, but as with anything related to QSBS, you have to make sure that it's done in a way that does preserve it. And maybe a side note, it's a great question, Yako. Maybe a side note is even for companies that are QSBS qualifying, it's important to not do anything that would disqualify the QSBS status. So moving shares around and so forth, you just have to keep a good record and make sure that status doesn't get jeopardized. I also see a question in the chat from Shalandra around stacking an option 2. So yes, in this case, you can take advantage of option. You can get the higher basis, and you can stack the basis on top of each other if you have multiple tax entities. So definitely doable. But if in most business owners' cases, if they're going to convert, I would say converting at a higher basis to minimize the taxation is a generally more advantageous strategy, because if you put it in a trust, there's restrictions around how you can use that money, or you can't use that money. So I would say if you had to choose, rather than stacking the high basis QSBS, I think it'd be more advantageous and flexible to get a higher basis in option 2 noted here. Okay, and then I see another question from Dave here. For a 1045 rollover, what if the seller buys another business, not starts from zero? I think, again, it's important to make sure the transaction is done in a way that maintains the QSBS qualifications. I think in particular, if the 1045 rollover is done in a way that the investment goes straight into the company and it's further original issuance, I think there's more benefit and they can potentially get more exclusion on top of that. If they buy it from an existing seller of a business, I think it would be a similar situation where the exclusion would be capped at the valuation of the original sale, and they would not be able to capture additional upside from that rollover. But again, this is something that I would definitely want to bring in a CPA and a tax lawyer that has done a lot of Section 1202 transactions, because there's a lot of nuances involved in there, and it depends on the situation. Yeah. All right. So feel free to keep the questions coming. I will keep a lookout on the chat. All right. So as noted, as I mentioned, a lot of times people say that private equity doesn't do stock deals. This is an example of a $1 million EBITDA M&A sell side that we ran. We got about a dozen bids, and as noted here, the top bidder was indeed a private equity firm that bought the stock in a QSBS conforming transaction. So definitely doable. And then the second layer of pushback that I often hear from M&A practitioner is, well, if private equity does a stock deal, they don't get the asset basis step up they get in an asset deal. So if you don't get the benefits of the asset basis step up, they're going to pay less. That is theoretically true. And I think if you did a textbook assignment, that's probably the result. But the reality is, as you can see here, value is kind of in the eye of the beholder for a given company. And these are all private equity firms bidding on this. We had some people bidding as low as 4 or 5 times, and top bidder bidding as high as 8 times. And this is where you realize that valuation is indeed maybe more art than science. So if you think about that, the value of that asset basis step up, the private equity firm does an asset deal, they're able to step up that basis, and then they would depreciate that over 15 years. And the benefit of depreciating that over 15 years is that they get a tax shield from that. They pay less taxes. So every year, they get the benefit of 1/15th of that basis step up. And then whatever the tax rate is, they get 30% of that in cash savings. So it's not actually that much. And so when push comes to shove in a competitive process, we see that the person that really wants to buy this business will be the top bidder, and they will qualify for QSBS. And that's the value of competition. I see another question. If your company is not qualified under qualified small business because of the industry you're in, what are other tax planning options you can do to prepare for an eventual exit? So I'll touch briefly on that. And I think I had a slide here.
Hey, Jay.
Yep.
Dave Cowan here also. In the interest of time, I know you have some more slides to go through, and you might touch on some of these upcoming questions. So we might want to go ahead and have you finish up the presentation. We can hold these questions to the end. I'll leave it up to you how you want to manage it.
No, sure thing. I'll take your lead there. So look, again, I just want to kind of point out here that I think in real life, private equity will do stock deals, and they can be the top bidder. And we see that, in practice. The last thing I'll touch on is if you Google QSBS, it will say consulting businesses or IT service businesses, they don't qualify. But then if you ask Google or ChatGPT, are there any private letter rulings that say that a consulting business or like an IT services business can qualify? And then it will produce these 2 private letter rulings, hopefully, if the model is good. And basically what it says is, if the business is not engaged in a trade or business where the principal asset is the reputation or skill of one or more employees, think doctors or lawyers, then the business can qualify. And essentially, as long as a company has a proprietary service delivery process, you can hire new employees, train those employees, and get those employees to follow your proprietary process. There's an argument to be made that it can qualify. And that's what these private letter rulings say. So again, it does kind of go into the niche nature of this section. I feel like the IRS left it intentionally vague. And so it's important to talk to people who actually done a lot of these in practice, not just read the Internal Revenue Code. So then I'm going to get towards the end of the presentation here. If QSBS is so great, why isn't everyone doing it? I think in this day and age, if we see something so great, whether it's on social media or news, and if everyone's not doing it, we think there's a catch. So why isn't everyone doing it? Well, there's a reason that people have been talking about it a lot until recently. Until 2013, the capital gain tax rate was only 15%. And until 2009, the exclusion on Section 1202 was only 50%. So the juice really wasn't worth the squeeze. It's only in 2013 when we had two elements. One, capital gains tax rate went up to 24%, and we would get 100% exclusion. This is when QSBS started to have a really big impact. So if someone started a company that's QSBS qualifying in 2013, it would only be by 2018 they started to qualify it because of the 5-year rule. We all know it takes more than 5 years to build a company that's ready for a sale. And I think that's why in recent years, you've been seeing more and more companies qualify and sell with the QSBS benefit, and more people are talking about it. There is a study done by the Treasury where they looked at the annual QSBS benefits gains, and the chart goes like this. So it's not surprising that more and more people are taking advantage of it. And I'm pretty sure going forward, it's only going to get more popular. So that's why it's starting to come into vogue as of late. And then there's a question of then, why isn't everyone talking about this now? And I think this is where I'm going to kind of put in a little plug for our business model, which David already introduced earlier on. The M&A industry traditionally has not been incentivized to talk about this, because if we are success fee oriented, we are focused on the headline valuation, and I could sell a company for $10 million and pay all the taxes. I could sell a business for $10 million and pay almost no taxes. The success fee doesn't change. So the success fee model has served the industry really well for a long time, but I think in the modern business of M&A, I think it does fall short, and there are a couple of blind spots, and one of them is around tax planning. I think the people that talk the most about minimizing taxes and QSBS are the wealth managers, the guys that are at Bernstein, Merrill Lynch, and UBS and all that stuff. The problem is most of us are not going to have a private wealth manager until we actually sell our company. And by then it's too late. So it's only when you do your next company, you'll realize what you missed out on. So this is where I think this kind of like hourly model helps cover all the bases, including minimizing taxes. So takeaway for today is, if you are considering a sale or a business in 3 to 5 years, we strongly recommend considering QSBS. It is one of the rare strategies that actually allows you to exclude, not defer, because most tax strategies are around deferment. It actually eliminates capital gains. And advanced planning can actually help you save millions, tens of millions in taxable gains. If you think you're going to sell in 3 to 5 years, if you already have some people knocking on your door, asking if you're going to sell, and if you're kind of considering it, now is probably the time to start planning and taking action. It is complex. It's a lot of work, but anything that can save you millions of dollars is supposed to be complex and a lot of work, and it'll be worth it, because when you retire with millions more in the bank account, that's going to change your life. Lastly, word of caution. This is probably one thing that you don't want to DIY it. I kind of compare it to like replacing an electrical socket. I could watch a lot of YouTube videos, figure it out, and maybe do it myself. And then 3 years later, I'll probably find out that I did something wrong and it blew up something bigger. So Google and ChatGPT are your friend, but when you actually put it into action, this is where you want an expert along your side every step of the way to make sure it's done right, and you don't find out 3 to 5 years later that somebody missed a step. QSBS is one of the most impactful tax strategies and one of the few things that can save you millions of dollars at time of exit. So I will stop here. Thank you very much. Happy to take any questions. And if we do have some time left over, I can talk a little bit about profits, interest, and phantom stock.
Terrific. Thank you, Jay. That was super interesting, super informative. In fact, while you were talking, I wrote to several of my clients that because they're not here today, they should listen to the recording when it's out. So thank you for that. So let's go back to the couple of questions. So there was one from, I think it was Fong Lei, if I get her name right. If your company is not qualified under QSB because of the industry you are in, what are other tax planning options you can do to prepare for eventual exit?
Yeah, I think the reality is because most of these businesses are S corps or LLCs, then the taxes kind of get to your personal level. I think when a client comes to us and says they want to sell their business, one of the things that we discuss is, especially if they're California or say Massachusetts residents, how do we move some of the taxable gains out of the state? Because California taxation on capital gains is pretty steep. So there are certain trust structures that allow you to mitigate those state taxes. Nowadays, there are some innovative financial tools like direct indexing or even levered direct indexing that allows you to accumulate tax loss harvesting over several years. So even if you don't have QSBS, you can harvest tax losses over a few years into hundreds of thousands, and that's still a lot of tax savings. The exit timing within the year is very important. For example, like deals that we have in market right now, all things equal, we're going to plan to close in early January as opposed to late December, because early January gives the seller an entire year to plan their taxes and take certain actions, such as leveraging real estate or other types of bonus depreciation, et cetera, to minimize those taxes. And again, the 1045 exchange can be used for non-QSBS situations as well. So it's for those that are looking to invest or start another business, it's worth looking at as well. So those are some, but I encourage people to talk to like a very exit-oriented tax advisor or a wealth manager that's well-versed on the personal level of different tax strategies. I think that's kind of probably you're going to be our best resource. And I'll also emphasize, taxes are one of those things where the sooner you plan, the more you'll save. And don't wait until you're ready to sell, because then you might miss out on a lot of those opportunities.
Terrific. Thank you. We have another, actually, it's more of a comment from Morris Chubb, and I think it was on the slide where you were showing the 10 valuations from 3.6 to, I believe, 8.2 million. And Morris simply makes the point that although the price might be less in a stock deal, the tax benefits of a QSBS would outweigh the slightly lower price. Any comment on that?
No, I 100% agree. I think even if the price was technically a little bit lower, I think the QSBS benefits would significantly outweigh it. Because again, the tax benefit is actually not that valuable to the buyer. But this was really more to illustrate that actually even the top bidder could be a QSBS qualifying bid, just because the nature of competition in a M&A auction situation. And just to maybe add to Morris's point, this chart serves multiple purposes. Obviously, in this case, the prevailing bids were all cash because the seller wanted all cash. But a lot of times in the middle market, we see highly structured deals between cash, rolled equity, earnouts, seller's notes. So we talk about I think we over-index to talking about the multiple in M&A. I think what really matters at the end of the day is how much cash is in the bank account when the deal is done. Because if the multiple is inflated by an earnout or a seller note or rolled equity, that's different from getting all cash at close. Money in the future is not the same as money today. So just something to keep in mind. It's a more nuanced question. I appreciate Morris kind of flagging that.
Yeah. Well, and Jay, not to disparage your colleagues in the M&A world, but is there a risk if you work with an M&A advisor who's not up to speed on QSBS and the potential value to a private equity buyer, for example?
Well, I think, and this probably goes to Dave's question as well. Most people engage an M&A advisor when they're ready to sell. So at that point, no one's going to say, well, why don't you just wait another 3 to 5 years and then you'll save a lot in taxes? I don't think anyone's going to have that conversation. But in the instance where a company, because sometimes we come across companies that didn't even know about QSBS, but they set up a Delaware C Corp because when they Googled it, they probably saw that Delaware C Corp is the way to go. And it's almost a blessing in disguise because they are a QSBS qualifying company. They could get capital gains eliminated. And I think in that case, it's just important to work with the M&A advisor and bring in a tax advisor that can attest to QSBS qualification. And when you get bids from potential buyers, make sure it's a QS ask for. You have to ask for QSBS qualifying structure because I can almost guarantee if you don't ask for it and you just ask for bids, almost every buyer will give you an asset deal.
Mm.
If you don't ask for something else, I'm going to give you an asset deal because the asset deal as a buyer gives me a better tax benefit and it shields me from residual liabilities. So unless someone specifically says this has to be a QSBS qualifying C Corp stock transaction, I'm going to throw an asset deal. Even then, frankly, we ask for it, and even then, a lot of times people will lob across an asset deal. Why? Because that's their template LOI. And if they put in 20 LOIs per year, they use that template, they just change the number and a few other metrics. So they might have missed it because this is the first time they're seeing a QSBS qualifying company. And again, in that situation, we go back and say, hey, notice that you put in a bid. It's an asset deal. In our process header, we ask for a QSBS qualifying C Corp stock deal. And sometimes the buyer, whether it's a strategic or private equity firm, will ask, what is that? And then we have to explain to them. Or sometimes they'll just recognize, oh, got it. And then they will fix the LOI and send it back. So again, if you don't ask, you don't get. Does that kind of address the question there?
Yeah, great point. Thank you. And Shailendra Gupta, who's also a M&A advisor, says even if the buyer agrees to a stock sale, they will almost always do an F reorg, so the seller is paying taxes as it was an asset sale.
Yep. Excellent point. And so we will say, actually, the process letter should say we're looking for, when I say QSBS qualifying, the real language is stock purchase with no 338H10 election. So the 338H10 election means that you can treat a stock deal as if it's an asset deal. So if they do a stock deal but make that 338H10 election, then it'll be nullified. So again, it's very nuanced.
Yeah.
And there's a lot of little pieces to just cover to make sure when all is said and done, it is indeed a QSBS qualifying deal. And from the process letter to the LOI review to the definitive agreement documentation, the M&A advisor has to work closely with the legal advisor to make sure and the tax advisor to make sure this is all done well. Again, kind of complex, but worth it because it saves you millions of dollars.
You just did a wonderful job, Jay, in terms of reinforcing your point. This is not DIY. So there's another question from And I don't want to lose it here. Let me roll up a little bit from Dave Howerson, who says, what are the options if the seller already has an LOI and closes in 6 months?
I think that goes back to Feng's earlier question. If you already have an LOI, that frankly restricts a lot of your optionality. For example, we had a client recently that's going to have a taxable estate because it's going to be a sizable deal. And there's an opportunity to do some gifting to family members at a lower basis so that she doesn't eat up as much of her basically, estate allowance. But if she gets the LOI, the gifting is going to have to be done at a valuation close to that LOI value. So we actually worked again with her wealth manager and tax advisor to effectuate the gifting before we received any indications of interest. So that helped a little bit with some of the gifting and minimizing estate taxes. But once you've already received an LOI, I would say your options start to get limited, and I think that's where the biggest impact lever we've seen, just to kind of reiterate the same point, is figuring out how using a trust to avoid some of the California capital gains taxes. That's still what 13%. So it's you wouldn't put all of it in the trust, but whatever you put in the trust can have a decent impact. And then some of the capital gain loss harvesting strategies, whether it's bonus depreciation or those levered index funds and whatnot. There are certain tools that allow you to harvest more capital losses without actually losing money. So those are some tactics. I can't say I'm an expert in all of those. I think that's where an exit-oriented tax advisor or like a wealth manager would be well suited. And the other thing I'll mention is I think a lot of people are afraid to approach wealth managers until they have that minimum AUM that people look for. But I found that these firms, if they know that there's an exit on the horizon 3 to 5 years out, they'll start working with you for that advanced planning. So again, same thing. If you don't ask, you don't get. I think it's worth reaching out to start thinking about some of these options that are available to you. I hope that helps, Dave.
All right. Terrific. Thank you, Jay. Any other questions? Or Ed, do you want to take people off of mute if they want to just speak up?
Certainly, on it.
I think there's one more question from Feng around, can you convert your LLC to a C Corp if your LLC members are in negative capital? I have not heard of any restrictions around that. Again, I would bring in a tax lawyer or CPA to confirm that. But I don't think it impacts QSBS. It's just important to note if your LLC is taxed as an LLC or an LLC partnership, or if your LLC is taxed as an S Corp. That would impact how you convert to a C Corp.
All right. And I think if anyone else has a question, I think you can come off of mute and ask your question directly. And seeing none, hearing none. Jay, do you want to go ahead and stop your share? And I want to, again, thank you for all of us from Modern Ideas for Business, and on behalf of all the participants. This was, again, super engaging, very interesting, and I think helpful for many of us on the call and the clients that we work with. So, Jay, thank you for a great presentation today.
Yeah, my pleasure. Thanks for having me.
And for those of you who are attended today, thank you all as well. Today was our last presentation of 2025. So we'll look forward to welcome you back on Thursday, February 12th for our first webinar of 2026. So you can go to the Modern Ideas for Business webpage, and here there's a sign up for speaker announcements link. Just go ahead and enter your information there, and we will keep you up to date on upcoming events, including our February 12th speaker when we announce them. In the meantime, we wish you all a very happy holiday season. Thank you so much for attending.